Welcome to Analyst's Estimate. We bridge the gap between Wall Street and Main Street by breaking down complex investment research so you don't have to. Disclaimer. This podcast is for educational analysis, not financial advice. AI powers much of our research, but AI can make mistakes, and data can occasionally be inaccurate. Treat this as a business analysis rather than deep company research. Always do your own due diligence before investing. Today, we're doing a deep dive into the final analyst report on Central Depository Services, or CDSL as most of us know it. If you follow the Indian capital markets at all, you know this company. It's not just a player. It's basically the digital plumbing that makes the whole system work.
That's a perfect way to put it. And our mission today is very specific. We're looking at this core contradiction really at the heart of CDSL's valuation.
Okay, lay it out for us.
Well, you have what is essentially a systemic utility. It operates in a regulated duopoly with NSDL. So the question is, how on earth does it justify trading at this enormous scarcity premium?
And that premium is what? Exactly.
We're talking a trailing 12-month PE multiple of 64.9 times. It's huge. And it's facing these, structural cost pressures that are visibly chipping away at its margins. So is that premium actually sustainable? That's what we need to figure out.
All right, let's start with the bull case then, the foundational thesis. Because without this, I agree, the whole valuation kind of falls apart. The market is betting on the financialization of Indian household savings.
Right, and that's just a fancy way of saying people are moving their money.
Moving it out of things like physical gold and real estate.
Into stocks, mutual funds, financial products. And that bet is paying off in a massive way. While we get into the weeds on ratios and margins, you have to remember the sheer scale we're talking about.
So there's not a small shift.
Not at all. As of March 2024, Indian households held INR 319 lakh crore in financial assets. CDSL is the main pipeline capturing that whole acceleration.
Okay, so let's quantify that acceleration. Give us the numbers that really show this momentum.
The growth is it's breathtaking. Investor accounts were up by a staggering 39.28% year over year in the 2024 financial year. That got them to 11.56 crore accounts.
And it didn't stop there.
No, it sped up. By FY25, total accounts had exploded to 15.30 crore. Just think about that. CDSL added millions and millions of new investors in just a year. It's a huge ongoing retail wave.
Which leads to the obvious question. If the growth is that fast, why isn't competition just flooding the zone?
And that's where something like Porter's 5 forces really helps. We scored the barriers to entry for new players and the threat of substitutes as ultra low, a 1 out of 10.
A 1. So basically impossible to compete. Why?
Because the government, through SEBI, has mandated digital dematerialization. I mean, if you want to trade legally in India, you have to use one of 2 regulated institutions. It's a regulatory chokehold.
So competition isn't the issue. It's an infrastructure necessity. And even the rivalry with the other player, NSDL, that's rated as low, just a 2.
Precisely. The rivalry is soft because CDSL has just overwhelmingly captured the retail side of the market. They have a 79.5% share in accounts. It's staggering.
So NSDL is more for the big institutional players.
Exactly. NSDL handles more institutional assets, but the retail flow, that's the future growth engine, and CDSL completely dominates it.
Okay, let's talk about the moat itself then. Getting over that 15 crore account mark must create a huge advantage. How does that size actually protect them?
It's classic economies of scale and network effects. Think about it. When you spread your massive fixed tech costs, and we'll definitely get to those costs later, across 150 million users, the cost per user gets incredibly low. It's a winner-takes-most situation.
That scale is powerful. But what about for the stockbrokers, the depository participants, or DPs that actually bring the accounts to CDSL? Why can't they just up and switch to NSDL?
The switching costs are immense. CDSL is deeply operationally integrated with 574 of these DPs, and they have 98% pincode coverage across India.
So it's just embedded everywhere.
It's totally embedded. It's like a bank trying to switch its core software provider. It would mean retraining thousands of people, recoding entire back-end systems. It's practically an insurmountable hurdle.
So what you're describing is a government-mandated, debt-free cash machine.
That's pretty much it, yeah. And the financials back that up. You've got an exceptional balance sheet, a debt-to-equity ratio of 0, plus a superior P/E margin of 48.63% and a high return on equity of 29.2%. On paper, it's the perfect high-quality financial utility.
And now, we hit the contradiction. We just laid out this case for explosive revenue growth, up 33.23% in FY25. But at the same time, we're seeing structural margin compression. EBITDA margins fell from 65% in FY23 down to 59% in FY25. So what gives? How is a near monopoly with a booming top line getting less profitable?
This is the critical trade-off. This is what the market is trying to figure out right now. The immediate cause for that margin dip is pretty stark. Their total operating expenses surged by 44.78% in FY25.
Whoa.
Yeah, that growth in costs just massively outpaced the 33% revenue growth.
A 44% jump in expenses is huge, especially for a business that's supposed to be asset light. What's the specific line item driving that? Is it hiring?
No, the deeper cause is all technology. Tech expenses went up dramatically. They jumped from around INR 10,421 lakh to INR 17,562 lakh in 1 year. And this isn't, discretionary spending on a fancy new app.
Right.
This was forced infrastructure hardening.
So there's a regulatory whip cracking somewhere. What's driving that mandatory spend?
The root cause is crystal clear. It's mandates from SEBI about Market Infrastructure Institution, or MII, resilience. SEBI is demanding more and more cybersecurity, more operational redundancy. Plus, they're preparing for this ambitious shift to a T+0 settlement cycle.
Instantaneous settlement.
Exactly. And these upgrades, they transform what might have been a one-off capital expense into a semi-fixed, unavoidable operating cost. CDSL basically has to treat its tech spend like a non-negotiable insurance premium for the entire market.
That's a great way to think about it. It's like a bank vault, where the regulator tells you to upgrade the locks every single year no matter what. And looking at their cost structure, tech and IT is now 45% of their operating costs. Employee benefits are another 29%. That IT piece is a heavy, heavy anchor.
And that brings us right back to Porter's forces, specifically supplier power. While CDSL doesn't have rivals, its supplier power score is high, a 7 out of 10.
Because they have to buy this tech from someone.
Exactly. They depend on specialized, often global tech vendors for this mission-critical stuff that SEBI requires. So when the regulator mandates an upgrade, CDSL has zero leverage. They just have to pay what these specialized vendors ask.
Okay, this is where it gets really complicated. We talked about that TTMPE of 64.9x. That is a massive premium compared to its peers. NSTL trades, around 35x? And even a sophisticated peer like CAMS is at 48.2x. So why does the market give CDSL this extreme premium?
There are two main justifications, really, beyond just the high growth. First is that utility status itself, that legally enforced moat guarantees revenue, and the market loves that stability. But the second, and I think more important reason, is the quality of its cash flow.
Okay.
CDSL has the lowest days sales outstanding, or DSO, in the entire peer group. It's just 13.3 days.
And for anyone listening, what does a DSO of 13 days actually mean in practice?
It means they turn their revenue into cash almost instantly. They get paid immediately for their services. This incredible cash velocity is why they can have a clean, zero-debt balance sheet. And it's why the market sees their earnings as extremely high quality, justifying that higher multiple.
But wait, a valuation that high, it demands spotless governance, perfect operations, and the report does flag some forensic red flags. This makes me wonder, why isn't the market discounting these issues more heavily?
That is exactly the right question to ask. We flagged three things. First, what we called evasive behavior. With this huge expense surge, you'd want clarity. But management consistently refuses to split those IT costs into one time versus recurring on their calls.
Which makes it impossible to model their future margins.
Exactly. If you don't know if that 44% expense hike is permanent or temporary, how can you forecast profits? It creates a lot of uncertainty.
And what about the quality of the earnings themselves?
That's the second flag. Some signs of earnings smoothing. The report noted what looked like unnatural reversals of tax provisions, specifically INR 203 lakh back in FY23. It's a strange adjustment that could have made earlier earnings look smoother than they really were.
Not a good look.
Not ideal. And finally, you're seeing the operational strain show up in actual regulatory penalties.
Which ties right back to those rising IT costs.
It does. CDSL paid about INR 3.1 crore in penalties to SEBI recently for tech glitches and reporting failures. It's the cost of not being perfect. It just reinforces that trade-off. They have to spend a fortune on tech or they get fined.
So let's quickly summarize the top 4 risks that could really challenge that 64.9x premium.
Okay, top of the list is market cyclicality. They're exposed to retail trading volumes. Then, regulatory intervention SEBI could cap prices or force even more spending. Third is cybersecurity vulnerabilities, a growing threat. And finally, concentration risk. Their growth is really tied to the discount brokerage sector.
All right, let's shift to the future outlook, beyond the immediate risks. Are there any non-discretionary tailwinds already locked in that guarantee some revenue growth no matter what the market does?
Yes, and the biggest one is their move into the unlisted space. SEBI has mandated dematerialization for unlisted private companies. This is a huge deal
Why is it so important?
because it's not dependent on retail investor hype. It's pure regulatory-driven growth. CDSL onboarded almost 3,500 unlisted companies in just 1 quarter. That's a powerful brand new revenue stream.
We should also touch on their financial dependencies, specifically other income.
Right. It's a big lever. Other income, which is mostly from treasury yields on their cash, currently props up 22.24% of their net profit. That's a significant chunk.
And that needs to be watched closely.
Very closely. If their treasury strategy changes or if interest rates fall, that income stream gets squeezed, and that puts immediate pressure on their profitability.
And we have to talk about the negative free cash flow. The FCF was negative INR 5,440.79 lakh in FY25. That number would usually set off alarm bells.
And it's a critical point of context.
Yeah.
The source is very clear on this. This negative FCF is not an operational failure. It's a function of their treasury strategy.
So they're choosing to do this.
Yes, they are actively moving cash into long-term bonds to manage their balance sheet. It's not because their operations are failing. In fact, net cash from operations grew healthily to over INR 44,000 lakh in FY25. The FCF figure is a balance sheet choice, not a sign of distress.
So if we pull back and look at the big picture for the next few years, what's the one key trade-off that everyone, management, investors needs to be watching?
It's a constant race between two massive opposing forces. On one side, you have to sustain that demat account momentum. They need that huge retail inflow, the 3.74 new accounts they got in FY25 to keep revenue growing fast.
Then on the other side,
On the other side is the continuous mandatory infrastructure spend for MII resilience and the T+0 settlement system. The whole question is whether the tailwind from new retail investors can keep outpacing the regulatory anchor of escalating costs.
okay, let's wrap this up. What does it all mean? We've looked at CDSL as this phenomenal utility. It's high growth, debt-free, with a moat that's legally enforced.
And
yet,
the cost of just maintaining that moat, which is driven entirely by regulators, is structurally eating away at their margins. It's transforming a passive utility into something that has to behave like a high-spend tech firm.
that's the core tension right there.
It is. If we connect this to the bigger picture, the market is pricing this company like a premium utility because of its moat and cash flow. That's where the 64.9x PE comes from. But regulation is forcing this financial utility to constantly invest like a hyper-growth tech company just to stay compliant.
So the final question for our listener is,
The ultimate question for you, the learner, is this. Do you believe the rate of new investor account growth, that powerful organic retail momentum in India, can continue to outpace the non-negotiable mandatory rate of regulatory cost increases year after year after year?
thanks for tuning in. Remember, this isn't financial advice, and since we utilize AI, always verify the data yourself. See you next time. Welcome to Analyst's Estimate. We bridge the gap between Wall Street and Main Street